Stop buying only VOO. 4 ETFs that have beaten the S&P 500. What if the investment almost everyone recommends isn't actually the one that has delivered the highest returns? Many investors put all their money into a single broad market fund and never look beyond it. But what if there are other options that have consistently outperformed it over the years? In this video, we'll look at 4 powerful investment funds that have beaten the market, why they've performed so well, the risks you should know about, and how you can use them to build a smarter portfolio. Let's get started. Section 1. Why VOO is so popular, but not the only choice. The Vanguard S&P 500 ETF, VOO, tracks the famous S&P 500 index, giving investors exposure to 500 of America's largest companies. With an extremely low expense ratio of just 0.03%, it has become one of the most recommended investments for beginners and experienced investors alike. Historically, the S&P 500 has delivered average annual returns of around 10% over very long periods, and VOO has closely matched that with strong performance in recent decades. However, in today's market, where technology and innovation drive much of the growth, simply holding VOO may mean missing out on higher returns from more concentrated strategies. Many ETFs focused on specific high-growth sectors have delivered superior results. Let's dive into the 4 standout ETFs that have beaten VOO. Section 2. VanEck Semiconductor ETF with ticker symbol SMH, the semiconductor powerhouse. The VanEck Semiconductor ETF, SMH, invests in companies that design and manufacture semiconductors, the critical chips powering AI, smartphones, computers, data centers, and electric vehicles. Performance deep dive. Over the past 10 years, SMH has dramatically outperformed VOO. While VOO delivered solid returns around 15% annualized, SMH has often achieved 28% to 37% annualized returns in strong periods, turning modest investments into life-changing gains. Top holdings usually include Nvidia, Taiwan Semiconductor, TSMC, Broadcom, AMD, and ASML. The explosive demand for AI chips has been the main driver behind this outperformance. Why SMH beats VOO? Semiconductors are at the heart of the digital revolution. As AI adoption grows across industries, this sector benefits from strong secular tailwinds. However, it comes with higher volatility due to industry cycles and geopolitical risks. If you believe in the long-term future of technology and AI, SMH deserves a place in your portfolio, but only as a satellite holding, perhaps a 10-20% allocation. Section 3. Invesco QQQ Trust with ticker symbol QQQ. Nasdaq 100 Growth Leader. QQQ tracks the Nasdaq 100 index, which consists of the 100 largest non-financial companies listed on the Nasdaq exchange. This makes it heavily tilted toward technology and growth stocks. Performance analysis. Over the past 10 years, QQQ has consistently delivered higher annualized returns than VOO, often in the 18-22% range. It particularly shines during bull markets driven by innovation. Major holdings feature Apple, Microsoft, Nvidia, Amazon, Meta, and Tesla. This ETF captures the Magnificent 7 effect better than the broader S&P 500. QQQ offers a great middle ground. More growth than VOO but still diversified across leading companies. Consider the lower-cost QQQM version for even better long-term efficiency. Section 4. Technology Select Sector SPDR Fund with ticker symbol XLK. XLK provides targeted exposure to the technology sector of the S&P 500, including software, hardware, semiconductors, and IT services. Historical performance. Technology-focused ETFs like XLK have outperformed the broader market significantly over the last decade due to digital transformation and cloud computing growth. Why it works? The tech sector continues to innovate faster than the overall economy. Companies in XLK often have higher profit margins and global reach. This ETF is ideal for investors who want tech exposure without the extreme concentration of pure semiconductor funds. Section 5. Schwab US Large Cap Growth ETF with ticker symbol SCHG or SCHD for balance. For the 4th pick, we include a growth-oriented option like SCHG, which focuses on large cap growth stocks, or SCHD for investors who prefer dividends and quality. Performance edge. Growth ETFs like SCHG have beaten VOO by selecting faster-growing companies, while SCHD has provided strong total returns with lower volatility in certain market environments. Section 6. How to build a smarter portfolio. Now that we've looked at 4 ETFs that have outperformed VOO over various periods, the question becomes, how do you actually use them in a portfolio? The biggest mistake many investors make is thinking they have to choose one ETF over another. In reality, successful investing is rarely about finding a single best investment. It's about building a portfolio where each holding serves a specific purpose. This is where the core and satellite strategy comes in. Think of VOO as the foundation of your portfolio. It provides broad exposure to 500 of America's largest companies, giving you diversification across multiple industries while keeping costs extremely low. For many investors, this can make up 50% to 70% of the portfolio. Around that core, you can add satellite positions, ETFs that target areas with higher growth potential. For example, if you believe artificial intelligence and semiconductor demand will continue to grow over the next decade, allocating 10% to 20% to SMH could increase your exposure to one of the fastest growing industries in the world. If you want broader exposure to innovative technology companies without focusing only on semiconductors, QQQ or the lower cost QQQM can be an excellent addition. These funds provide access to many of the world's leading technology businesses, including Apple, Microsoft, Nvidia, Amazon, and Meta. For investors who want technology exposure while staying within the S&P 500 universe, XLK offers another compelling option. It concentrates on established technology leaders and can complement VOO without venturing into smaller, more speculative companies. And if you prefer a more balanced approach, SCHG can tilt your portfolio toward faster-growing large-cap companies, while SCHD offers exposure to high-quality dividend-paying businesses that have historically demonstrated strong financial health and consistent cash flow. Dividend-focused investing can also provide a smoother ride during periods of market volatility. One example of a balanced growth portfolio could look like this: 60% VOO for broad market exposure, 15% QQQ for additional exposure to innovative growth companies, 15% SMH to capitalize on the long-term semiconductor and AI trend, 10% SCHD to add dividend income, quality, and stability. Of course, this is just one example, not a recommendation. Your ideal allocation depends on your age, financial goals, investment timeline, and personal risk tolerance. Once you've built your portfolio, consistency becomes far more important than constantly chasing the latest winning ETF. Instead of trying to time the market, consider investing on a regular schedule using dollar-cost averaging. By investing the same amount every month, you naturally buy more shares when prices are low and fewer when prices are high, helping reduce the emotional impact of market swings. It's also a good idea to review your portfolio once or twice a year. If one ETF has grown much larger than the others, you can rebalance by trimming some gains and bringing your allocation back to your target percentages. This simple habit helps maintain your desired level of risk over time. Remember, the goal isn't to own every high-performing ETF. The goal is to build a diversified portfolio that you can confidently hold through both bull and bear markets. Long-term wealth is often created not by making perfect investment decisions but by staying invested, remaining disciplined, and allowing compounding to work over many years. Section 7. Important risks and final thoughts. While these ETFs have impressive track records, they carry higher risk and volatility than VOO. Sector concentration, economic slowdowns, interest rate changes, and valuation corrections can lead to significant short-term losses. Remember, diversification is key. No one can predict the future, but combining VOO stability with selective outperformers can potentially improve long-term results. Thank you so much for watching this in-depth video. If you found it helpful, please give it a thumbs up, share it with your friends, and subscribe to the channel for more detailed investing content, ETF reviews, and portfolio strategies. Hit the notification bell so you never miss an update. Drop your thoughts in the comments. Which of these ETFs are you considering adding to your portfolio? Until next time, invest wisely, stay patient, and keep learning. See you in the next video.